Let's take a look now at some picks from the small cap sector with some small cap stocks to watch. Joining me here in the studio on my right is Graham Neary from Cube Investments, Cube.Investments. Graham, good to talk to you. And on my left is Chris Boxall from Fundamental Asset Management. We've spoken to Chris a lot before. And Graham is new to us here, but has got some interesting picks for us today. First of all, how would you group your picks in terms of the sector?
Sure. So these are all financial stocks. So you could argue they all have some risk that's related to the economy in terms of cyclicality. They all need to be valued in their own specific way, and perhaps not all of them should be valued in relation to earnings. Some of them are valued in relation to book value on the balance sheet. But they each have their own strengths. Some of them are unique. In fact, they're all unique in their own way. And I think what I'm trying to put for your viewers today, Jeremy, is a basket of stocks that maybe they could hang on to for a while. In some cases, I've been holding on to these for years.
OK, all right. Let's quickly introduce Chris's picks. What do you got for us in terms of the broad sweep?
Mine's a sort of more random bunch. We've got some recovery plays, or a recovery play. We've got a software play, a software and a hardware combined sort of product, a growth play. Then we've got a sort of a gentler compounder within the IT services sector. And finally, somebody involved in litigation funding, which has been very, very hot, a really hot area. And I think this one's quite undervalued at the moment. It has a big opportunity, big opportunity. OK, hold the name of that. Just remember, we'll get back to you and some of those. I want to begin first of all with you, Graham, if I can, and take a look from the top down. Financials. I want to begin first of all with something that perhaps maybe people might not really have considered as pawnbroking. And you've got one pick, but I know you're going to mention another one as well. H&T. Tell us what's going on.
So this is an example of a small cap, which is actually the #1 in its industry, which surprises people sometimes that you can have small companies which are so important in their field. H&T is the UK's biggest pawnbroker. 122
million market cap.
That's right, yes. And it has a loan book of 20 million, but that's the personal loan book. But the really interesting bit for me is the pawn book, so the pledge book essentially of pawned items, which is over £50 million now, still growing at a decent clip. And the competitor, which we're going to talk about as well, is Ramsden's, which is a smaller entity. The interesting thing about Ramsden's and H&T is that they generally don't compete with each other head on in the same geographical area. H&T is more in the south of the country, whereas Ramsden's is more in the north of the country. But I've been holding H&T for 6 years now, so a decent stint, and pays a nice dividend. The valuation, in my view, is not terribly racy. It's at a small premium to book value. Book value is £110 million, and it generates a pretty consistent return on capital of about 10%, so it's a solid performer.
You can see here we're the highest we've been since July 2018. Chris, you're in this as well. What do you like?
I like it as well, but it frustrates me a little bit. I think it's a very well managed business, quite a conservative, prudent business. And as Graham alludes to it, geographically it's very southeast dominated, with Ramsden's more northern. And I feel it could do more, and it could learn a bit actually from Ramsden's. Ramsden's makes an awful lot of money out of foreign exchange. In fact, that's its main earner. So it gets people into the shops, and it's really become a past master at selling other products to those customers that come into the stores. Whereas H&T has clearly more costly stores and could sweat them a bit better, in my opinion.
This is the problem, isn't it? It's the fact you're investing in bricks and mortar as well, which is pretty much sort of old hat, isn't it?
Well, it's a very unique position that H&T has, because actually in a recession or a weak environment, there may in fact be more demand for pawn loans and personal loans. And H&T has a lot of flexibility because they also have a retail brand called Established 1897. So in areas where there's actually more demand to buy jewellery and buy watches rather than to pawn them, H&T can present itself on the high street as a retailer of jewellery, and it does that very regularly. So it has that flexibility, and it uses it.
What would change your view on the 6 years you've held it? What would mean you want to sell? Is it a share price issue, or is it something else fundamental that perhaps may be bubbling in the background that might be of a concern?
Well, strangely, the number of stores at H&T has declined gradually over the last few years, and I've been absolutely okay with that. H&T has 182 stores, which is down from 193 years ago. Ramsden's, on the other hand, is attempting to expand, including through acquisitions. So I think with H&T, what you're buying into is a very conservatively managed business that really knows what it's about. So H&T presents itself as a pawnbroker. It has a £50 million pledge book. Ramsden's, in contrast, has a tiny pledge book, relatively, of only £7 million, and it presents itself as an international financial services provider that's diversified. So for H&T, you've got very clear, we're the number one pawnbroker, that's what we do, and as long as they keep doing that, I'm happy.
Don't you think that, I mean, I hold both, and I like both. My frustration is, going back to H&T, is the return on equity, as you alluded to, is only about 10 and a bit percent. Ramsden's is double that.
Right.
So they're making a double return on the capital at play, which is commendable. I mean, it's an amazing achievement, really, given the sector, which is illustrated perhaps of this bigger foreign exchange exposure. They're also growing strongly in retail as well, in jewellery and high-end watches.
Are you buying and holding as well?
Yeah, I'm a buyer. I'm a regular buyer. I have been a buyer of Ramsden's, and less so of H&T.
Chris, let's turn to one of yours, ADEPT Technology. To begin with, it was ADEPT Telecom.
Yeah, and as the name change implies, it's a business that's moved from telcos and earning from voice and telecommunications to one that's now a general IT service provider. This business has delivered consistently ever since it listed, and it had to do that through some really tough times. The CEO has now stepped up to chairman, and it's had to evolve its business from a telco to a managed service, and that's brought with it a very, very consistent earnings, 75, circa 80% recurring revenue through managed service contracts that they have with big corporates, and specifically with the education sector. So they're a huge provider of IT services to the education sector within London. I think they supply circa 3,000 schools or something like that, schools and educational establishments. I like it. It does sweat its balance sheet quite heavily. I mean, it really generates decent returns on equity.
Define that. Do you mean it's got a lot of debt on it? It's
got quite a lot of debt, and however, it's also a terrific generator of cash. So in isolation, you look at it and you think, wow, that's a heavy debt load, 200% net gearing, something like that, based on equity. However, it's a terrific cash generator, and from internally generated cash, it's acquired other businesses, and it continues to be very acquisitive. So many people may be put off by the debt load. However, this business really, in terms of operating delivery, hasn't missed a beat since IPO, which is amazing given how it's evolved, and also we had a pretty tough period with the financial crisis.
Yeah, financial crisis. I mean, this is an interesting area. You talk about your financial expertise. Do you touch tech at all? I mean, is this something you would be interested in?
Not in telecoms, no. No.
Why not? What is it that steers you away from that sector?
Well, I generally don't invest in utilities.
Right.
So for me, the entire utilities sector is very capital intensive, very regulated. There may be some small cap opportunities. Like Manx Telecom is an example of a small one, but I generally find that I
call that the worst managed business on AIM, I think, Manx Telecom.
We've spoken about that before, haven't we? It's something that you're not too keen about. The risks, I mean, the reasons that Graham doesn't like these sort of stocks. You happy sitting with that risk?
Well, this isn't a telco. So this is a business that has contracts with schools and other businesses, and it has to support those businesses' their IT. So if you have a problem with your computer, or you want to extend the network, or you want to change your hardware, you're going to be calling up ADEPT Technology. They could also provide you, with your telephone needs. However, nowadays, that's largely based through the internet. It's not fixed line as it used to be. So everything is getting bundled together. And it's very compelling. You're not going to move. There are two positives. You're unlikely to drop your eye. If they're providing more and more services to you, they're not going to be dropped. However, that can work the other way. It's very hard to pick up business as well. Because it's so sticky, it's very hard to pick up business organically. So the primary area of growth is through acquisition, which comes with an element of risk.
Yeah. Chris, let's stay with you for the next one and go to Pressure Technologies, ticker symbol PRES. This is market cap at 24 million, a little bit smaller than ADEPT Technology.
Yeah, this is really in our micro cap, well, sort of penny stock arena, although it's not sub £1 anymore, the share price. This business has disappointed a great deal since it listed. It flew out of the blocks, driven by the growth in oil and gas. It's a specialist engineering business, and it has really two areas now. It makes seamless steel cylinders, many of which go into the defence sector, and also oil and gas drill ships as compensation systems. And the other is it are specialist engineers, so milling and machining engineering pieces. Those businesses are very nice, very nice, very decent margin, 15-20% margin, nice business. The cylinder business is hugely cyclical, and it's been horrendous. It flew out, and it's more than cut in half. It also got involved in biogas cleaning. And unfortunately, it was ill-timed. And really, though, it's an indictment on the lack of support for renewable energy, I think, in this country. So it had quite a nifty, it was called green lane biogas, that clean gas for injection into the grid. And that was a real struggle. And they've now semi-offloaded that business. They've got a carry. It's been delisted, effectively, or extracted from the AIM-listed company, and as a separate listing on the Toronto Venture Exchange. They picked up a bit of cash, and they've got some equity in this Canadian listed business. Now, it really is it's my recovery play. It's disappointed for so long. Some people say you should never invest in anything made out of metal. This business is perhaps an example of that. But I think it has a better chance now. And should it recover, the recovery could be meaningful. There is big upside potential in here if it gets some support through oil and gas.
There's a should and an if in there.
There's loads of. That's where we are with it. 20 million market cap.
You tempted at all? I know you don't do this area, but
Yeah.
I mean, has Chris sold it to you as an opportunity, or what are your objections?
I'd be curious if they have any competitive advantage.
Their cylinder business is pretty high spec. They're one of very few suppliers into the drill ship market, and most importantly, their key competitive advantage in the defence sector. It's very hard for them to get replaced in the defence sector. It takes a long time to get signed off as a supplier to British Aerospace, and they're supplying stuff for the Astute class submarine. So it's very tough to get replaced in that area. So that is a competitive advantage. You could say their history of cylinder making is a competitive advantage. In the engineering side, less of a competitive advantage. However, their components are relatively low cost in the grand scheme of the entire project, and you don't sort of compromise in quality when you're dealing in £1 billion worth oil and gas projects.
But there's no IP to speak of.
There's no IP, not even in the cylinder area. Yeah.
Okay, Graham, let's turn to you for a couple of yours. Duke Royalty with ticker DUKE. This is a royalty investment company. These are really interesting, I think. And I mean, you do hear about some of these sort of companies going to the wall. I know they make bad investments. So what is it about Duke Royalty you like?
Well, Duke is legitimately unique in the sense that it's the only quoted diversified royalty company in the UK, and it's brought a business model or financial model over from North America. Now, most people associate royalty investing with the resource space, but Duke is not focused on resources. Duke is focused on leisure, technology, industrials, media companies. It's really quite open-minded in terms of the sectors that it covers, but it doesn't do resources. So from that perspective, people might say it's a higher quality of proposition. Now, it's very interested in paying investors a solid yield. So the yield, they're paying about 2.8p per share trailing, and that's likely to increase. And as they diversify, which is their main challenge because they're still very young, as they diversify, they become lower risk. As they become lower risk, possibly the share price could reflect lower risk. And the interesting thing about the contract or the royalty agreement that they sign with their investees is, as these companies grow their revenues, they pay more cash to Duke. And that could be over a period of 30 years if the agreement continues to last that long. So to the extent that they make the correct decisions, which is yet to be seen, they could enjoy a nice rising stream of cash flows. And they've had a good start. They haven't had any mishaps yet, so fingers crossed.
Yeah, anything to tempt
I don't get it. We differ on this one. I just don't get it. I mean, I don't. Graham can put me right here. I mean, first of all, the this is really expensive funding. So my common sense tells me that surely the companies who they're injecting loans to or provide lending to are higher risk than norms, because these companies are paying a fortune. You know, it's, what is it, a percentage of turnover?
13-14%.
Equivalent. So it's very expensive. Why do it unless you can't get it from anywhere else? And secondly, I don't understand the recyclability. Once you've given your money out to an investing company, how is it come? It's not like a normal lending arrangement when you've got turnover and recycling of it. I just don't get. So it's a pure yield play, and in order to grow their book, they're going to have to keep raising more and more capital from shareholders.
Is there much competition in this area? I mean, what Chris has said sounds to me completely logical. They've got to keep on going in order to get the money back on to pay investors. Is there much competition, or they?
It hasn't really been done in the UK. They actually made a small acquisition of another company that had started to do the similar thing in the UK, but it's not really a model that exists here. And I agree that this is a high risk play in the sense that we should expect mishaps within the portfolio.
If one goes wrong, I think one of their investments represents about 15% of their
Well, I was going to say, how big are they? How big is it?
Yeah, so I've actually, because I've spoken to management a couple of times, and I've urged them to lower the payout ratio, to actually pay lower dividends to shareholders, because I want them to build a buffer of safety. So what they've told me is that royalty companies like this in North America would typically pay out between 60% and 80% of cash flow to shareholders. I'd be happy for that to go to the lower end of the range, and I think that's possible. And if they were only paying out 60% of cash flows, that would help to compound wealth within the business and would build a safety buffer. So I hope they will do that. If
one of them goes wrong, I mean, your payout's going to be cut materially. As you alluded to, they need to diversify the book considerably, don't they?
Yeah.
Is that why we've got such a helter-skelter ride, or a roller coaster ride that you've got here? Is it?
Yeah, I mean, they're going to have to. I mean, they probably will raise significant amounts of new money over time. So it's hard to predict what that will do to the share price. But I suppose, for people who are a little bit adventurous and willing to give them a try, I mean, I've spoken to them a good few times, and the way that I treat it is a corporate mortgage. So it's like you mortgage your business for 30 years. There's no bullet payment at the end. The repayment happens all the way through. And Duke is the senior secured lender, so in the event of a default, Duke should be able to achieve a reasonable outcome.
Yeah. Okay. Are you invested?
I'm invested in everything I talk about today. Yeah.
Okay. Park Group. Let's stick with you, Graham, and go on to your next one. UK's #1 multi-retailer gift voucher and Christmas savings club. Now, a few years ago, this sector was in the headlines for all the wrong reasons.
Oh, right.
Not this company, but there was a company that fell foul of Christmas lending. Explain why you like Park Group.
Well, the way I've tried to explain Park Group to people is that it's part of the infrastructure of the retail system. So Park Group is the #1 company in the UK, again a leading position for a small cap, in gift vouchers and prepaid shopping cards. So when if you buy an all-for-one card, that's Park Group. And if you have a reward scheme with your employer, which might be a large corporate, they might pay you in Park Group gift vouchers. So it's a leading company, and you can see that if you look at their return on capital, it's about 150%. The return on equity is about 250%, and the reason is that it's just a digital piece of the infrastructure of the shopping economy. And I mean, they can make money in a variety of ways. They hold a lot of money in trust, and they can earn interest. Also. Now this
interest rates are very, very low.
Oh yes, absolutely. But I suppose it's in some ways it might be a speculation that interest rates might rise, which may not happen. But the other thing is, if customers don't redeem their cards, who gets the money? Yeah. So now clearly we'd prefer if customers actually all used their gift vouchers, but if they don't, it's breakage. It comes back to Park Group. So they have a couple of ways to make money. They're still growing. In terms of billings, revenue, their 2018 numbers were quite good. 2019 looks a little bit slow, but they have a new CEO. They're working on a new product, which they're very secretive about. They haven't told us what it is yet. But I just think that it's not going to quadruple tomorrow, but I don't think it's going away.
Do you like the idea of this? Or
Not a fan. So I don't get it at all. I mean, this is a business that is lodged in the late 20th century.
That's right.
Low single-digit growth. I mean, sorry.
Just one final question. How much of it is concentrated around Christmas? I mean, there's this big lead-up of people paying into these sort of Christmas.
Yeah, so I think about 3/4 of their revenue is in H2, so it's heavily weighted to Christmas.
I think they could do more with their listing by getting out of this business, saving their cash and putting it into something with some growth prospects.
Okay, Chris, let's move on to the next one. Should they put it into QUARTIX?
Oh yes, they should. They should
Why?
indeed. I just think this is a lovely little business.
Right.
I think it ticks all the boxes. Any investor would want to look for. It's got nearly. There are some little issues perhaps, but management own a load of the stock. Is management of founders. It makes high returns, or high operating margins, great returns on equity, terrific cash flow. It is the cleanest reporting business on AIM. Year end is 31st December, gets its accounts out, audited accounts by 25th of Feb. Management pay themselves modest sums. So it is so fully aligned. And what does it do? It makes vehicle telematics. So it puts these devices into cars. It started off doing it for the insurance sector, but it's now, that is in decline. This is the sort of blip. The insurance business is in decline, through whom they had an arrangement with a business called Winelli. Right. And the big growth opportunity is in providing these telematics devices for fleets, so small commercial fleets. They put them in. They have a long-term rate, 3-year plus generally recurring revenue stream from them. They control the software. They're assessing all the data. It's one of those businesses that everybody should look for. Lots of small business customers, loads and loads of them, with lots of repeat revenue. And as I say, the insurance decline is a bit of a short-term headwind, but then again, they've got great growth in the UK, terrific in France. They've just started, they're about second year into the United States, which is a massive opportunity. They've recently launched Polish and Spanish websites, all from the same platforms. These are translated, and ironically, it's all of the overseas business. Most of it is managed from Wales. It's great.
I agree with Chris that the reporting from QUARTIX is terrific, first class, and I agree it's a high quality business historically speaking. But I suppose where I'd be nervous, maybe too nervous, would be how does the telematics industry evolve? 5-10 years from now, I mean, a lot of cars might be able to do their own telematics. I mean, I'm not a fan of Tesla, but Tesla claims that it would be able to measure driver behavior with its existing in-car technology system.
In-house, yeah.
So I don't know if this is a long-term situation here.
Yeah, I think it's addressing. I agree, that is a risk. Technology is addressing a very different market. So, for example, in the US, it's sort of hit upon a sweet spot of landscape gardeners. A lot of Mexicans doing landscape gardening, so it's really sort of focused in that area. Small fleets, 5-10 vehicles maximum. They're not you're not upper end. This is sort of lower end workforce.
Did you take an opportunity to buy into this most recent?
I'm a regular buyer of QUARTIX. Actually, I'm a big fan. You get a decent deal. You get 4% dividend. So they don't need all their cash, and they're chucking it back immediately to shareholders what they don't need.
Let's go on to your last one, Chris. You mentioned legal services. This is the one, ROSENBLATT, RBGP.
Yeah, I think this is interesting, and I think people are starting to take notice. It's a legal services business, but it's got a specific, really a focus in dispute resolution and sees a huge opportunity in litigation funding. And if we look at litigation funding, one thinks of the Burfords and previously Juridicas, and there's another one, a smaller one called Manolete, and it's been a very hot sector on AIM. And my query with it all is, why on earth haven't the litigators, started funding their own work? I mean, they're intelligent, they're generally pretty wealthy people. Why are they giving all the margin away to others?
Have you asked them? Is that something
I have, and I think ROSENBLATT's sort of answers that to a certain extent. They've got their own pot of money, and they're willing to put that pot of money to supporting these claims, which could be an interesting dynamic. And they have a terrific reputation in the marketplace. So I think it could be an interesting time to get involved with Rosenblatt.
Yeah, I mean, I've not been able to suspend my disbelief yet, specifically on Burford.
Yeah, I agree.
You know, the returns are so unbelievably mouth-watering and amazing. And I would have thought it was like a financial stock where it's like a fund that they're deploying and they're earning a return. How are the returns so big? How is competition so weak? Or is this a genuinely new area? To me, it's just too amazing.
I don't get it. We never see the cash either with Burford. It's all in that little magic box of theirs. I don't know. But if you're a litigator, you're working for Burford and seeing how much they're getting out of effectively your work. It's just bizarre for me. I mean, Rosenblatt, I think, can be there and be it could be a major force in this area. Well, a major force in a small part of it.
Okay, Graham, let's round it off and go with your last pick, which is PCF Group. Back to the financial sector, obviously, with your sector of preference. PCF.
Yeah, so this is, you could call it a challenger bank. It's an established lender. I think it's been around since 1994 or thereabouts. It deals with motor finance for consumers and asset finance for companies. So it's not exactly a glamorous stock. But what triggered my interest in PCF was the fact that they got this bank license around the end of 16, and then the start of 17. There was a long regulatory process. But what it's meant is that they are now taking customer deposits. So if you've got some spare cash, you can open a deposit account with them online, earn a couple of %, and from an investor's point of view, it's fantastic because these are cheap deposits. It's a cheap way to fund a lending operation. So I have some numbers here, but essentially their deposits have exploded. They've got £200 million of deposits from retail customers now, which has doubled in the space of a year. And that's funding most of their lending activities now. So and their lending activities are exploding as well. So they're at well over £250 million now. They're targeting £750 million in the next couple of years. And as they get bigger, they get operational gearing. Yeah? So as a bank gets bigger, its fixed costs become less important as a percentage of the whole. So they're looking to generate a return on equity of 15%, which would be a fantastic result
for a bank,
for shareholders.
Phenomenal.
Yeah, I mean, and there's no legacy business, and I was just looking at the price to book value today is about 1.4, so you have to pay a 40% premium to book value, but if they are making progress, if they work up towards 12, 13, 15% return on equity and it's sustainable, it could do very well.
So what are they doing with the cash? They're just piling it back in, or
they're reinvesting. So the dividend yield's very low. I can't remember. It might be about 1%, but it's a growth story.
Yeah,
I think it looks interesting, but I noticed that there was a declining net interest margin. So they pay out their the lenders for 2%, and the borrowers are getting charged 10. So you make about 8 and a bit in the middle, the spread in the middle, and that's been declining. That was my only sort of concern with where things are going.
Yes, and they referred to competitive pressures. As they have gotten bigger, they've been moving up the credit spectrum, so more of their customers are in the prime end. It's very competitive around here. Also, in the business side of lending, they've said that there's actually been an increase in fraudulent practices and basically people not doing what they said they were doing. So there probably will be an increase in defaults, a small increase. But I guess the bull thesis is that the operational gearing is just going to overwhelm these minor changes in the net interest margin.
An exciting bank, that's what you're alluding to. Wow.
Okay, look, we've got to leave it there, gentlemen. Thanks indeed for joining us for this look around the small cap sector. Joining me today was Chris Boxall from Fundamental Asset Management and Graham Neary from Cube Investments.